Hey everybody. Hello, hello, hello. We'll get started in probably about like a minute just to give everybody time to come in. Feel free to use the chat if anybody's got a question throughout the webinar. I think you can actually speak too. I don't know how that works, but if you raise your hand, I think, and you have a microphone, I can select you and you can talk. Odds are, if I know the history of me and technology, that probably won't work. So go ahead and feel free to use the chat. Or jump in the chat, or jump in the chat, or use the microphone. 6 o'clock. All right. Maybe just 30 more seconds. It looks like a couple more people are piling in here. Thanks everybody for showing up. Especially seeing as the advertising, a lot of it was tomorrow night. I set the webinar. I thought I was going to do it tomorrow night. I set up the advertising for tomorrow night. And then I guess the people who set up my webinar here in the software set it up for tonight. So I said, whatever, I'll be home. So let's do it. I think if enough people email me and complain, I'll probably end up doing it tomorrow night as well. And then next Thursday as well, if you know anybody who'd like to check in. All right, cool. I don't want to keep anybody else waiting. Let's start it. Let's start. This is talking about the big, beautiful bill and how it saves retirees on taxes. Lots of things in the big, beautiful bill, but really only a handful of things that I want to talk about tonight for retirees. And I can't imagine it going past a half an hour depending on questions. All right, let's jump in. Stick around to the end if you'd like to get my book and brochure. That's on the safe money strategies that I use, creating your own income like a pension and just safe money. We can talk about that. If you just want to learn more about me, you can go to my website. A lot of this stuff is not on the Panic Proof site. It's on my Bridge River site, bridgeriverllc.com. That's the company that has all the money in the stock market. So those are just my TV appearances. Then I also have a YouTube channel, talk about a bunch of stuff. Did a tax-free retiree show for a while. That's when I had really, oh, look at this hair job right here. Whew. Oh, my wife hated that hair. Look at that hair, wow. Okay, excerpts from my seminar as well on the website, if anybody cares. Okay, let's jump in. July 4th, Donald Trump signed into law the One Big Beautiful Bill, landmark piece of legislation that makes permanent many provisions of the 2017 Tax Cuts and Jobs Act and introduces several new tax measures. In my seminars for the last few years, of course, I was warning everybody to do Roth conversions, right? Because if this went away, a lot of the brackets go up. One of them goes up 9% if you were doing conversions, but now we don't have to worry about it. We've got another potentially 4 years, right? And then whatever the heck happens after that. All right, so let's talk about the tax brackets real quick. Let me get my arrow back in. All right, so as everybody knows, probably we have a a progressive tax system, meaning you're only taxed 10% on this slot of your income, whether you're single or married filing jointly. 12% on this bracket, 22% on this bracket, 24% on this. So when you kind of blend it all in, the idea is whatever bracket you're in, thank you for bothering me during my webinar, whatever bracket you're in, if you're at the top of the bracket, subtract 8%, and that's kind of the blended rate you're going to pay on all your money. Meaning, if you're at the top of the 22% bracket, subtract 8, you're probably paying about 14 to 15% blended on all your money, right? That's kind of the rule of thumb. If you're in the bottom of the bracket, then maybe subtract 5 or 6, and that gets you your blended rate. Again, at the top of the 12% bracket, you're probably paying, 6-7% taxes. Okay. So that's the progressive tax system. And again, something I talked about in my seminars that's going to still be good for the next 4 years is the fact that, the 22% bracket that most people are in, I would say, gets you all the way up to 103 if you're single and 206 if you're married filing jointly. However, the next bracket's up, so only 2 percentage points more, right? And that gets you all the way up to 197 and 394, meaning Roth conversions, right? So if your income is just your normal income is Social Security and pensions or dividends or whatever it is, money withdrawn from your IRA, you can convert even more and really only go up 2 bracket points and get all the way up to $394,000 if you're married, 197. Okay, so that luxury of being able to do that just got extended permanently permanently, but 4 more years, right, or until the next president changes it. So if you've got a couple $100,000 of income, and meaning you're at the top of the 22, if you're married, you could convert another $200,000 to get you all the way up to 394, and you're only paying 2 more percentage points, right? Not a clear slam dunk for everybody, but it's at least should be looked at, right? Should be examined. Okay. Anything else about the tax brackets? I don't think so, because when we start getting into some of the benefits of the big beautiful bill, I wanted to at least give you a background of how the tax brackets work. Most people know this, but let's go on. All right, so the other thing that was made permanent was the getting rid of the personal exemptions. If you remember, before Trump, in his Trump 1.0, everybody got a $6,000 personal exemption, I believe it was, per kid and per EU. So basically, a married couple and all these kids, each got a personal exemption, and then a standard deduction as well of $6,000. So you can see this picture. These kids would have gotten a lot of personal exemptions. Well, that went away, and we just all got one big fat standard deduction, which really helped my clients a lot, because in retirement, that's really what you took, right? You don't itemize anymore, so you just take the standard deduction. So what is the standard deduction now? Well, it's increased now. The increase is made permanent. Again, that higher deduction was made permanent, and it still increases with inflation. Okay, so now it's $15,750 for single in 2025 and $31,500 for married. And like I said, it will go up every year. What is the standard deduction? Again, most people know that's just the ability to offset income, so you don't pay any taxes on that. So 31,500 of income that you can have withdrawn from your IRA. Maybe it's capital gains, maybe it's dividends. All that can be offset if it's under 31,500 for married, 15,750 for single. However, this started the bonus deduction for seniors. So if you're 65 and up, you can claim an additional $6,000 deduction for each person. So single 6,000, married 12, for tax years 2025, unfortunately through 2028. I'm guessing why he did that was so he could still say that he upheld his campaign promise. However, the campaign promise, but because he let it expire in 2028, I think that got it through the votes much easier. So he was able to get it through, obviously the votes and get it through. So I think I'm sure why he did that. Unfortunately, it goes away in 2028. But what he did is, this cracks me up, he tied this deduction to Social Security somehow. So he could say, well, I didn't make Social Security tax free, but look, I get a big fat deduction to those on Social Security. Well, it actually has nothing to do with Social Security, right? You don't even have to be on Social Security and you'll get this deduction. 65 and up, you get this deduction. Okay, so it has nothing to do with Social Security at all. It's kind of like if you found $5 in the street and then you went in and bought a coffee for $5. Yeah, the coffee was free, but it had nothing to do really with either one, had nothing to do with each other. So, yeah, so that's just how they word things and how they get away with it. Excuse me. So there you go. So now look at that standard deduction, man. If you're married, $43,500 you get to use to offset any income. $21,750 if you're single. That's pretty powerful. And this next slide I'm going to show you exactly why. Just in case for those of you joining late, jump in the chat if you'd like, if you have any questions, or I think you're able to speak if you have a microphone on your computer. I don't know exactly how that works, but I'll try to make it work. Okay. Awesome. All right. So the next slide. Oh, this is not the next slide, but we're getting there. All right. So just to kind of refresh too on how your 1040 works before we get into that discussion. So most people know on your 1040, that's where, oh, I wanted an arrow. Come on, give me my arrow. There is where your Social Security, your full Social Security benefits end up, right? However, Social Security is taxed on provisional income, so it matters what other taxable income you have, what makes Social Security taxable, and that's kind of something that we use to our advantage in our practice to keep Social Security tax free. So we kind of take advantage of the way it's taxed because not all of it ends up as into the taxable around, right? No matter what your situation is, worst case scenario, only 85% ends up in the taxable amount. However, my goal is to get it down as much as possible. Now, one thing I always like to make people aware is if you've got tax-free municipal bonds in your regular brokerage account, that tax-free interest goes here. And yes, it is tax exempt, especially if it's a Michigan state municipal bond. It's federal and state tax-free. However, that interest that is in here goes into the calculation that they use to figure out how much to tax your Social Security. Okay, so any monies, why can't I do my, any monies here will affect how much money here ends up here, just to make it a little bit more convoluted, right? All right, so just going off on a tangent, but basically, again, we're going to talk about how to get less from here into here using that new big fat standard deduction that we got in the BBB. All right, so this is what it looks like. Okay, let me get rid of this for a minute. Oh, this kind of made it, well, here, let me see. Sorry, I'm not familiar with my slides yet. Okay. All right, so this one, let me get into this one again before I get into the big slide. Sorry, first webinar in a while, kind of rusty. All right, so this is kind of cool, I guess. What was going on was because nobody could itemize anymore because the standard deduction was so high from Trump 1.0, no one was able to deduct charitable contributions. Okay, so what's cool here is even if you're only taking the standard deduction, yes, you can still deduct charitable contributions above and beyond the standard deduction to the tune of $1,000 for single, $2,000 for married. So nothing, unfortunately, fantastic. I wish they would have bumped that up higher. Would have been good, obviously, for charitable contributions, but it is what it is. So most people I know at least do that, giving to churches or whatever. So again, now we're up to 45,500 if you're married, 22,750 if you're single. Okay, so we're getting really, really high, which makes it even more possible, easily more possible to get completely tax-free in retirement. And let me show you how that works. So again, let's say you do you're between the ages of, the appropriate ages to get the 6,000 per person. You give a couple thousand if you're married to charity, 1,000 you're single. Here's what we're looking at. Okay, so in a hypothetical situation here, we've got Social Security. Okay, so single, say you're getting 30,000. Married, we've got one person, who maybe is made 30,000 and the spouse will have 15. So just 45,000 standard or 45,000 Social Security, pretty straightforward. So how it works is if you don't have any money, when you total up all these first buckets, and if they don't exceed the standard deduction, that's going to make your Social Security tax free. Now, that's not 100%. I'm trying to make it really high level, just rule of thumbs. But I would say 95% of people that I meet, as long as their regular income does not exceed that standard deduction, it will make your Social Security completely tax free. So in this situation, 90,500 if you're married, if that's your income, you are not going to pay a dime of taxes until 2028. And then it could change, obviously, because they're going to get rid of that 6,000. So, right, that's pretty powerful. Am I like missing something here? Let me do a deeper dive on that and let me explain that. Here are the three main buckets of money that we're dealing with. Did you know, by the way, the number one thing that Home Depot sells are these orange buckets. That's the number one thing that they sell. All right, so 3 buckets of money. Okay, so IRAs, right? That's all if 401ks, 403bs, 457s, SEPs, simples, ton of different accounts that defer your monies, right? And when you withdraw any money from those accounts, it's taxed as ordinary income. That's the income brackets I showed you at the beginning of the webinar. Okay, that's regular income tax brackets. So just depending on how much you withdraw, that's how much is going to be taxed. The second bucket of money is non-retirement money, non-qualified money often called. That's just your regular brokerage accounts, savings accounts, whatever, nothing that's anything that's not deferred. Okay, something where every year you're going to probably get that love letter from the IRS. It's called the 1099. So it could be, if you own a mutual fund and a brokerage account, mutual funds buy and sell all day long without asking you. Those kick off 1099s. You have to pay taxes on those gains. They kick off dividends, right? That causes a 1099. That's all taxable money. Okay. And then Roth money or life insurance too, or reverse mortgages. All that stuff is all completely tax-free money. Okay. So those are the 3 main buckets of money. We know how Roths work basically, right? Money coming out of that, you're not paying any taxes. There's 2 5-year rules on Roth withdrawals, just so you guys know. If you're over 59 and a half, the first 5-year rule doesn't even count, which means if you're over 59 and a half, the only 5-year rule that matters to you is the earnings. If you've not had any Roth open for at least 5 years, those earnings could be penalized if you haven't had any Roth open for at least 5 years. But I tell you what, the first thing that comes out of Roths are your contributions. Those are always tax-free, penalty-free. Conversions is the next thing that comes out. And if you're over 59 and a half, as I was just saying, that's completely that has no penalties on it, completely tax-free. And then once you've depleted all that, that's when you get into earnings. Okay, so I don't think I've ever met anybody who's ever even gotten to that point. So for the most part, if you're over 59 and a half, you don't have to worry about the 5-year rules. Okay, so what this means is any money coming out of IRAs or the 1099s, as long as that is less than the standard deduction, then it's going to be offset by the standard deduction, right? Which means your Social Security will be tax-free. Okay, and that's about as powerful as it can be because most financial advisors they just don't grasp that. And to be honest with you, CPAs don't either because they use software. They don't go into the nitty-gritty of how provisional income works and how you can arrange your assets to not pay any taxes. Okay, so that's really the really cool part about the Big Beautiful Bill, of course, and just the way we at Panic Proof Retirement and Bridge River Advisors handles taxable income. Oh, and by the way, you could have as much income as you want from the Roth. It don't matter. It's not going to affect anything. It's completely off the IRS radar. So again, if you're married and you've got 45,000 in Social Security, $45,000 of bucket 1 and 2, bucket 1 and 2, starting to get a little bit arrowy. You're not going to be paying any taxes. Again, money from IRA, a non-IRA money, whatever. If that's less than 45,500, your Social Security is going to be tax-free. You could add on another 30,000 from Roth. You won't be paying any taxes, and you have an income of what is that? 80, 95, $125,000, and you're not paying any taxes. Okay, people don't grasp that concept, so it's foreign to people. Okay, so that's why the Big Beautiful Bill for those who have that age requirement for the next 3 years, really powerful, really, really powerful. The only caveat here is pensions eat up the standard deduction as well. So if you got a pension, that's going to come off dollar for dollar. Nothing you can do with that. Cry me a river. You got a pension. What are you going to do, right? But most people don't have pensions. So you've got bucket 1 and bucket 2 that eat into that pension. And then as long as that money's not above that, you're golden, guys. You are absolutely golden. Now, you will see here, I have, don't forget the required minimum distribution. So, because some people think, all right, well, cool. I'll just, as long as I have the right amount in all these different buckets, I should be good, right? Well, the problem is you've got to figure out if this IRA money, by the time you reach your required minimum age, right, either 73 or 75 now, that required minimum distribution could force you into way above these standard deductions and get everything out of whack. So you just want to keep your eye on that and make the decision at some point. Do you want to get some of this IRA money into Roths by doing Roth conversions? Maybe you take advantage of it during this window when we have this big fat standard deduction and that extra standard deduction from the Trump thing, the big BBB, and do conversions so your required minimum distribution isn't greater than the standard deduction. And then it will continue to keep Social Security tax free. And that's kind of the analysis that we do all day long at my business to make sure we're doing the right thing on that. Okay. So again, if you're here, can I go back to the tax brackets? Oh, it's a little slow, so give me a time here while I flick through. Anybody has any questions? Feel free. Yeah, here we go. So again, if let's say there's not a whole lot of taxable Social Security. So let's say you're getting 40,000 of taxable Social Security, not much is taxable because you don't have a whole lot of income above and beyond Social Security. I would venture to guess you're probably not out of the 12% bracket. Again, meaning if your income is 80,000, 40 of that is Social Security, and not much of Social Security is taxable, and the other 40 is offset by the standard deduction. You're not even paying any taxes at that point. So that might be an opportunity to do some Roth conversions. And the analysis just needs to be done. What does that Roth conversion do to your Social Security, right? So we have to realize that every time you're converting, yes, you're adding taxable dollars to the bucket, but you're also adding previously tax-free Social Security to become taxable. So we just have to make sure we calculate all that, okay? And then obviously we want to make sure we stay below the IRMA brackets so it doesn't affect your Medicare premium. Okay, but that's pretty high, the Medicare premium, so you'd have to be doing some serious conversions before that messes with you. But still, we gotta make sure we're looking at it, right? So if I confused you a little bit, call the office tomorrow, make an appointment, and we can talk on the phone or whatever. Let's see, I think some people joined late here. Yeah, if you join late, feel free to chat, and also feel free to. Well, it looks like somebody just chatted, but then I don't see anything in the chat window. Oh, sorry, Nabil, you did chat. But the 6,000 is up to 70. Oh, yes, sorry. Did I not put that in there? Then it is less by 6%. Is that accurate? Yes. Sorry, let me go back to that. I think it was in the smaller print. Yes, here. Sorry, I didn't mention that. The deduction phases out for those with a modified adjusted gross income. So your AGI, your modified adjusted gross income and regular adjusted gross income for most people is the exact same. So yes, once it starts exceeding 75,000 bucks, 150 for married, it does start to phase out. Okay, so the 6,000 slowly decreases. It does go up to a really high income though before it goes to zero. But point taken, to Bill. Thank you for bringing that up. Okay, so before I kind of go off that slide, if I didn't completely confuse everybody, just make sure there's no questions on that basic concept. Don't forget RMDs. I'm pretty sure I mentioned that, right? I'm sure I did. Yeah, because you could have the income from bucket one and bucket two under your standard deduction before required minimum distributions. But if you don't keep your eye on that bucket, it can get pretty high pretty quick. and that's going to mess everything up. And from 73 or 75 till 85, 90 is a longer window than just maybe doing some short-term conversions to avoid that longer window of higher taxation, right? Bunch of things you got to think of. This is the other one that happened. No tax on tips or overtime. Okay. And again, most of my clients being retired, this is not something I did some major research on, but basically the income tax deduction is available to non-itemizers. Again, for those taking just the standard deduction because they can't itemize above it, they're able to take this deduction above and beyond that. Okay, which means it can be claimed in addition to the standard deduction. Okay. And the deduction has no effect on Social Security and Medicare taxes. Okay. And the deduction only applies to the portion of overtime pay that's a bonus over regular wages. And it only applies to federal income taxes. And again, it goes away in 2028. So Trump's attempt to probably easily get it through to become law, and he can say that he fulfilled his promise. And yes, it also does begin to phase out for 150,000 for single, 300 for married. Okay. The temporary auto loan interest deduction, again, this is also phases out or it ends at 2028. But I thought this was interesting, up to $10,000 in interest. You can deduct on a new car loan. It's got to be American, of course, but it was defined as final assembly of the vehicle must take place in the United States. I have no idea how they're going to determine that. I'm sure somebody knows that. I just don't know who makes that final decision. But again, this deduction is also available above the line, which is nice. So you don't have to itemize to get it, but up to $10,000 on interest in a new car. And just so you guys know, if you lease, no, you cannot take that deduction. Okay, and the vehicle must be purchased after 2044, final assembly, blah, 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 deductions available. Yeah, I already said that. Okay. Next, the new Trump accounts. So a new tax advantage savings account for children born between 2024 and 2029 on this one. So every newborn gets $1,000 from the government. So tell your grandchildren, you've got to create the account. They throw in 1,000, and you can contribute up to $5,000 every single year. It's got to be invested in a domestic, basically index fund. So like ticker SPY would work, right? The Spider S&P 500, which is awesome. No withdrawals allowed until a child reaches 18, at which time the account becomes like a standard IRA. Earnings grow tax deferred. Qualified withdrawals, though, are taxed as long-term capital gains, which is interesting. So 15% for the most part. If it's a qualified withdrawal, non-qualified taxed as regular income. And then, of course, pre-retirement withdrawals are allowed for certain expenses. So it's just kind of like an IRA at that point. One thing that I don't hear often in the news is new children. All children are allowed this account. It's just only newborns born between those years is when they get the $1,000 from the government. So whatever. Okay. I just did some quick math. If it's making about 7% a year, and with $1,000 put in and $5,000 every year, if the parents are going to do that, you have about $185,000 when they're 18, and that would be the balance. Okay. Interesting, but if you're thinking of doing it for college, the 529 plans are still the best because if you're using it for qualified expenses, it's completely tax-free. Okay. So, but kind of interesting, whatever. It's a good first step. Let's put it that way. Maybe future presidents can change it and make it better. Okay. All right, that's it, folks. I knew this was going to be a short one, half an hour. If you have any questions, certainly jump into the chat right now, but I haven't had dinner yet, so I'm going to be leaving very quickly. So what now? If you want to learn more about the money that's in the stock market company of mine. That's bridgeriverllc.com. The safe money stuff is panicproofretirement.com. The number is 844-44-PANIC if you want to give us a call tomorrow and get on my calendar. And that number goes for, it doesn't matter, Bridge River, Panic Proof. Obviously, we're all the same employees. We're all the same company on Woodward there, just north of Long Lakes and on Long Lake. And of course, if you want to make your own appointment, you can just go to catalinlee.com/retirees. Make sure you spell Catalinlee right. And you can book your own appointment. That is it. Last minute for questions, everybody. Thanks everybody for joining me. Dave, Larry, Nabil, Calvin, Suzanne, Cindy. There will be a replay of this if you really care. And it will be emailed to you if it hasn't already. You guys can watch it. Watch the replay if you care to, or share it. And tell everybody that I'll probably be doing, definitely will be doing this again next Thursday at 6, maybe tomorrow night because of the mess up. Oh, and I promised that my book and the kit for the Safe Money Start stuff, just whatever, shoot me an email or call the office tomorrow or whatever you want to do. I think you can even text. No, I don't think you can text it. Whatever you want to do, and we can get that book out to you, and the brochure for the Safe Money Start. That's the panic proof stuff. All right, no one's shooting me questions, guys, so I'm out of here. Thanks, everybody. Have a good night.